Hi everyone, my name's Kashish and welcome back to this grand experiment that we are calling Just a Little Beyond the Headlines. Now our last episode did do well enough so that I could keep this thing going for another 3 days. So if you're enjoying it, do me a favor and hit that like and share button. So if you're new around here, this show is basically an offshoot of the Daily Brief. Over there, we end each episode with quick tidbits, those extra headlines that didn't make it to the main news. And because some stories deserve more than just a quick mention, we've rounded all of them up here in a more comprehensive manner. But don't worry, we won't just regurgitate all the headlines. You'll get that one extra insight you can't glean from a cursory scroll through the news. That's why we are calling it Just a Little Beyond the Headlines. Because, well, it is. And we are keeping it neat with the EIC format. E for economy, I for industry, and C for company. Think of it as your daily coverage from the big picture stuff to nitty-gritty corporate moves. Alright, enough build up, let's dive in. Let's start with the economy news for first. First, we have Business Standard reporting that state government accounts hold nearly 1 lakh crore of unspent money meant for centrally sponsored schemes. Now, the biggest chunks belong to Pradhan Mantri Awas Yojana, Jal Jeevan Mission, Amrut, which is for urban transformation, Swachh Bharat Mission, and others. Together, these programs account for 45% of the total unutilized funds. Now, each scheme uses a SNA, which is a single nodal agency account, which a state government designates to hold and release funds on time. This system aims to avoid idle money while states still borrow for development. However, these accounts remain stuck with unused funds. Meanwhile, the latest budget allocates another 1.6 lakh crores to central schemes, a 7.2% jump from last year. So, why do states keep such large sums unspent? Observers once worried about corruption, but now they point to weak implementation, sluggish planning, and delayed approvals. If the money can't reach the people it's meant to help, what's blocking the pipeline? And can states fix it before more funds pile up? The next story is about India's exports. India's exports have been under pressure, declining for 3 consecutive months. There is some positive momentum on electronics, engineering goods, and pharmaceutical exports, though. Meanwhile, imports are climbing, driven by rising gold purchases and steady demand for energy products. Now, the United States remains India's largest export destination, followed by UAE and the Netherlands. On the import side, China, Russia, and UAE continue to dominate, supplying essential raw materials, energy, and industrial inputs. Now, contrary to what the data is saying, some commerce officials see this as a strong performance. They feel that despite global trade tensions, India is still able to maintain steady export flow, which is worth commending. However, commodity price fluctuations and tariff uncertainties remains a big risk, especially after Trump's retaliatory tariff plans, something we have talked about in depth in our Daily Brief episodes. The rupee's depreciation is another factor. While it makes exports more competitive, it also increases the cost of imports, particularly oil, which India depends on heavily. And for the third news, high-level talks between US and Russia have kicked off in Saudi Arabia to find a way out of Ukrainian conflict. However, Ukraine and European nations feel sidelined because no one invited them to the table. Ukraine refuses to accept any deal made without its input, and the European leaders have called an emergency meeting to plan their next move. Europe's absence raises serious questions about its alliances and security. Now, investors anticipate that governments will boost military expenditures to strengthen the continent's security posture. Companies such as BAE Systems and Thales have experienced significant stock price increases, with some shares rising over 7%. Now, this rise has shot European stock markets to new highs, with indices like DAX 40 or Stock 600 reaching record levels. Now, on to few industry news. First, the Hindu business line reported TV ad spending has slowed, but print advertising is holding steady, which is defying all expectations. Despite digital revolution, advertisers are rediscovering print's ability to create localized and high-trust brand experiences. Even with fewer advertisers, print ad revenue continues to grow, driven primarily by elections and festive demand. Meanwhile, TV ad revenue is struggling as brands hesitate to spend on expensive primetime slots with uncertain reach. Digital remains dominant, but print is proving its worth by offering targeted and cost-effective campaigns. Advertisers see value in creating print ads that capture attention and sometimes even go viral, as you would have seen on Twitter. Now, industry experts predict print's modest growth might continue, though digital will keep gaining ground. However, it's important to note here that TV still commands a much larger share of ad spending than print. Now, growth rates might be shifting, but TV remains the bigger player amongst traditional media. Now, for the second story of the industry, the Business Standard reported that global pharmaceutical giants are preparing to introduce new weight loss medications in India to combat nation's rising obesity rates. Now, these drugs are known as GLP-1 receptor agonists, which help in regulating blood sugar and appetite, which indirectly promotes weight loss. Now, Eli Lilly plans to launch its drug in India by 2025, pending regulatory approvals. Novo Nordisk, which is another company, aims to introduce its drug by 2026, though efforts are underway to expedite this process to 2025 so that it aligns with their competitors' timeline. Now, distribution strategies here include partnerships with local firms to navigate India's complex market. However, pricing remains a significant concern. Now, you see, due to patent protections, these innovative drugs are expected to be priced at a premium, posing challenges to India's price-sensitive market. High costs may limit widespread adoption, especially since long-term use is often necessary for sustained weight loss. Now, the Indian government is considering incentives to promote local manufacturing of these drugs after the patents expire, which could reduce costs and improve accessibility. Now, for the third industry story, the Business Standard reported that India is set to unveil its first domestically produced semiconductor chip by September-October 2025, which is a key milestone in reducing our dependence on global suppliers. Tata Electronics, in collaboration with Powerchip Semiconductor Manufacturing Corporation, that's PSMC, is leading this effort at Dholera Semiconductor Fab in Gujarat. The government is pushing semiconductor self-sufficiency, investing in gallium nitride technology, and offering financial incentives under its semiconductor mission. However, while this chip marks a progress for sure, it is unlikely to immediately rival with advanced processors from the likes of US or China, which have decades of research and manufacturing scale. Now, India's first generation chips will likely serve in automotive, telecom, and industrial applications rather than cutting-edge AI or consumer electronics, as we've seen chips from China and US are used. With semiconductor market projected to reach $63 billion by 2026, this step is crucial, but catching up with global giants will definitely take time. The success here depends on scaling production, securing supply chains, and continued R&D investments. That's the most important one. Now on to the final section about company news. First, ET reported that Titan Company, the Tata Group's jewelry arm, is eyeing a stake in Damas Jewelry, or however that's pronounced, for 4,500 crore rupees. Now, Damas is a big jewelry retailer in the Middle Eastern region. If this name sounds familiar, it should, because this is Titan's second attempt at bagging it after a previous deal fell through 2 years ago over valuation disputes. Now, there is no official confirmation of this development yet, so keep that in mind. Now, the GCC region is a key target for Titan's international expansion. The UAE in particular ranks as the world's 5th largest gold jewelry market because of its impressively high per capita consumption. Titan is already there with its Tanishq brand operating in Dubai, Doha, Sharjah, and Abu Dhabi. And now it looks like it wants a bit more. Now, here's a reality check. According to Harvard, 70 to 90% of acquisitions crash and burn. Titan's track record is a mixed bag here. Talking about CaratLane, this was a major win for them, which now pulls in around 6% of their revenue. Whereas there was another acquisition they made back in 2011 or 13, if I'm not wrong, which was of a Swiss watchmaker. Now, I don't know how to pronounce their name, but that acquisition didn't go well. They ended up selling it to Ethos in 2023. For the next news, ET reported that TCS, which is India's largest IT firm, is facing a lawsuit from its former employees. Ex-employees claim that TCS misused the L1A manager visa to bypass the strict H1B visa rules. Now, what's the difference between these two visas? Let me explain. H1B visas are limited and require some form of lottery and have very strict salary rules. L1A visas are meant only for executives and managers, and they have no cap and fewer restrictions. Imagine H1B visa as a concert with limited tickets, whereas L1A visa is like a VIP pass for executives. TCS is accused of handing out these fake VIP passes to avoid the lottery. Employees are alleging TCS of falsely classifying regular workers as managers so that there is easier approvals of all these visa applications. Now, TCS here is denying all the acquisitions, saying it is following the US laws. The Department of Justice has declined to intervene, saying that they don't have enough evidence. But If proven true, this could lead to penalties, visa restrictions, and stricter oversight on Indian IT companies operating in the US. And finally, Licious plans to become profitable first and then launch a $2 billion IPO by 2026. In 2023, it commanded a $1.5 billion valuation. Now, the company operates in 20 Indian cities and offers fresh meat, fish, spice mixes, spreads, ready to eat products, and a lot more. After it goes public, Licious plans to use the IPO funds into deeper market penetration, smaller store acquisitions, and much bigger operations. India's IPO market raised around $20 billion in 2024, second only to the US, and Licious hopes to ride that wave. It also wants to give its early investors an exit and solidify its position as a top branded meat player. However, with demand slowing post pandemic, the company must prove its strategy whether or not it can handle pressure. And that's it for today. If you guys enjoyed this new experiment, do let us know in the comments, and I'll see you in the next one.